let's just dive right in. Have you ever wondered what the truly successful investors are doing behind the scenes? Spoiler alert, they are not just picking funds at random and crossing their fingers. No way. In this explainer, we're going to look at exactly how the pros use structured systems, not random emotional choices, to build serious wealth over time.
Think about it like this. Are you currently on a road trip without a map? Because, investing without a crystal clear strategy is exactly like taking a long drive with absolutely zero directions. Sure, you're moving, you're putting money away every single month, but are you actually going to reach your destination? Probably not. You need a designated route.
So, here's our roadmap for today. 1. The foundation, basically starting the car. 2. Navigation, where we choose your route. 3. Tactical driving, adapting to the road. And finally, 4. Investment potholes, those massive mistakes you've got to avoid.
All right, let's hit part 1, the foundation. Time to start the engine.
Okay, let's jump into our very first strategy, which is the simple SIP. I mean, it's the most popular strategy for a reason, right? Look at the numbers. By just tuning out the market noise and consistently investing a fixed amount, let's say just 10,000 rupees a month for 20 years, at an assumed 12% return, you're looking at a massive 1 crore corpus. It's crazy. It forces incredible discipline, totally takes away the stress of trying to time the market, and actually makes volatility work for you over the long haul.
But wait, what happens when you get a raise? Enter strategy 2, the Step Up SIP. You really shouldn't just stagnate and invest the same flat rate forever. By simply bumping up your investment by just 10% each year as your income grows, you literally nearly double that final corpus. It's a total game changer. You start with the exact same base, but stepping it up just a little bit every year, the compounding effect goes absolutely off the charts.
Moving on to strategy 3, asset allocation. This brilliantly shows why you never, ever put all your eggs in one basket. We've got equity for growth, debt for stability, hybrid funds to keep things balanced, and gold or REITs for that sweet diversification. Balancing growth with stability actively pulls down your risk. If one sector takes a beating, the others step in as a shock absorber for your whole portfolio.
Okay, the engine's running. Let's move to section 2, navigation, mapping out your route.
Now, this master matrix right here combines strategy 4, goal-based investing, and strategy 5, age-based strategy. It shows exactly how your portfolio needs to shift over time. Like if you're 25, you got a super long runway, so go ahead, go heavy on equity. But say your goal is buying a house soon, you'll need a hybrid or debt mix. For your emergency fund, it's got to be highly liquid and debt-focused. And naturally, as you hit 55 or approach retirement, you've got to rotate heavily into stability and debt. Your strategy has to grow up right alongside you.
Strategy 6 is the core and satellite approach. This one is brilliant because it perfectly blends a rock-solid foundation with those targeted high-growth opportunities. Think of it like this. Your core portfolio is your anchor, highly stable, predictable index funds. Then, orbiting around that is your satellite portfolio, filled with your mid-cap, small-cap, or thematic funds. It gives you that extra adrenaline kick of growth, but without betting the entire farm.
Up next, section 3, tactical driving, adapting to the road.
Let's talk about strategy 7, SIP plus market opportunity. This is where you flip market fear into a massive advantage. The steps are so simple but incredibly powerful. Step 1, never stop your normal SIP. Just don't touch it. Step 2, keep an eye on indicators like the RSI. When it drops below 30, everyone's panicking. Step 3, that's when you inject extra capital. While the crowd is running for the exits, you're casually stepping in and buying up assets at a massive discount.
Strategy 8 is rebalancing. So imagine you meticulously set up a 60-40 split between equity and debt, nice and safe. But then a roaring bull market hits, and boom, your equity balloons to 75%, leaving debt at 25%. Without you doing anything, your portfolio just became way riskier than you wanted. Rebalancing just means you systematically skim some of those equity profits and move them back to debt. You lock in your gains and reset back to your original balance.
Finally, let's hit section 4, investment potholes, the critical mistakes you need to dodge.
You have to avoid these 7 common strategy killers at all costs. We're talking having no strategy at all, chasing recent returns because of FOMO, over-diversifying your portfolio into a cluttered mess, completely ignoring your actual life goals, failing to factor in inflation, and pulling your funds out way too early. But you know what the absolute worst mistake is? Caving to the urge to stop your SIPs when the market drops. Guys, that is literally when your money is buying the most units.
Here's the real insight, the whole crux of the matter. A completely average fund, driven by unbelievable discipline, will almost always crush a top-tier fund that's managed with emotional, erratic behavior. You really don't need to stress yourself out hunting for the absolute best fund. If you pick middle-of-the-road funds but stick to your system like glue, you're going to win the long game against the guy who picks genius funds but constantly panics.
So the ultimate takeaway from this explainer? Wealth isn't an accident. It's not luck. It is the deliberate, calculated result of a disciplined strategy and absolute patience. Good strategy plus patience equals wealth. Period. Start your engine, map your route, and stick to the plan.
As we wrap up today, I need to remind you, this conversation is for educational purposes only. Mutual fund investments are subject to market risks. Please consult a qualified professional before investing. Now, before you go, I want you to ask yourself, out of these 8 strategies we covered, which one is glaringly missing from your map today? Figure that out, keep learning, stay disciplined, and I'll catch you in the next explainer.